Good morning, everyone. Good afternoon, good evening, wherever you might be. Thanks for joining us here today for the May edition of the Market Insights, where Jeremy Fehr has taken a lot of your questions. This is kind of the new format we've been running things where you guys send in your questions and he'll go through them, whether they're equity markets based or headline issues, currency, interest rates, inflation. He'll be going over those in a second. My name is Paul Vendrinsky. I'm one of the portfolio managers here at SIA Wealth. And before I turn it over to Jeremy, I just wanted to cover one thing because we're getting a lot of questions about the one of our funds that we sub-advise for. This is the BMO SIA Focused North American Equity Fund. We've got a lot of questions lately, and we haven't highlighted this or showcased this on one of these calls in a little while. So I just wanted to throw up one slide to answer a few questions that we're getting here. This is a snapshot, obviously, as of the end of April, but I wanted to mention that we've had a lot of activity this year alone. Over the months, especially during February and March, saw a lot of trading. Overall, up until mid-May here, we've had fairly significant turnover. Over 100% of the portfolio has turned over, not meaning that every single position that we had at the end of the year has been sold. In fact, a number of them have held steady, and we've seen some good gains. But I just wanted to mention that it's sort of reminiscent of what happened during the last election cycle. Q1 of 2017 was very similar to what we saw here, in that a new administration has come in, a fair bit of uncertainty, and we ended up seeing a lot of sector rotation, which has been very similar to what's taken place in a lot of the various funds that we sub-advise for. And on top of that, obviously, COVID, the rollout of the vaccinations, and all of the uncertainty going forward has obviously added to that. But I just wanted to mention a few things about that. Some of the more volatile sectors, and traditionally, especially on the Canadian side of the border, has been in the energy and the metals and mining space. And we have seen that. We've seen some rotation in and out of similar or the same names over the last 4.5 months here, but it's played out very well for some of these. For example, Ovintiv, a position that we don't hold in the portfolio anymore, was sold and garnered a realized return of over 80%. So that worked out well. That's in the energy space, obviously. And then tech from the metals and mining space, similar situation where we exited the position this year and realized a return of over 54%. So those very volatile sectors have paid off pretty handsomely. Some of the other stuff where we've got in and out of over the last number of months saw relatively small losses or relatively small gains. So not a lot to report on the stuff we got rid of, except for the ones I just mentioned. But some of the names that have held in here since the fall, names like Gildan, names like Caterpillar, Canadian Tire, General Motors, these are some names that are still in the portfolio. They have been for quite a while now, but based on the way we analyze things, find these winners, and a lot of times they hold at the top of the rankings and continue to be held, obviously, while they're performing and are strong. As you can see here, one of the big changes from the end of last year was technology. You're not seeing any right now. We had 20% weighting into technology at December 30th, and a big rotation. I think one of the questions Jeremy will be talking about is the NASDAQ. That might explain some of that. We've seen an increase into financials. We had 0 at the end of last year, moved in to almost just over a quarter of the entire portfolio. And that consumer discretionary space, which has been the bulk of all holdings for really about a year now, has increased to about 40% of the portfolio. Even though the names within that sector can be very different, that's a big area of concentration. And last but not least, I just wanted to mention, because we get a lot of questions on this about the Canadian versus US. You can see right now, we're still heavily weighted to the US side of the market. This isn't always something that moves in lockstep with the currency, because we're on a relative strength basis looking at where's the strength, whether it's in the US or Canadian side of the border, from a Canadian investor's perspective. Just to give you a little bit of history on how this has moved. At the end of September, for instance, we only held 3 Canadian positions. Moving into late February, that increased all the way to 8. And now I believe we're sitting at 7 positions in Canada. So again, not necessarily correlated with the US Canadian dollar, but there is some relationship, especially with current commodities, being a top ranked asset class, where we're seeing involvement within the portfolio into both the energy space, the metals and mining, and even lumber. So that was the quick update I wanted to do. If you guys have any questions, feel free to reach out to myself or Kyle, Ted, or Jason at any time. And on the monthlies now, we're adding a lot of bullets, something else that you guys have asked for speaking or direct speaking points on what's taking place in the portfolio and how to communicate that with your clients. So with that, I'd like to turn it over to Jeremy and to go over the market insights for the month of May. Thank you, everyone.
Thanks, Paul, and thanks everyone for taking the time this afternoon. It's certainly been a very, very interesting last couple of months. As Paul mentioned, we've had significant rotation in the markets and some signs that maybe we're getting a little bit lofty, especially in areas like the NASDAQ. So we'll get into it. So today we've got 5 questions that have been emailed in to us for me to answer today. So keep those questions coming. It's great that the contribution that all of you are making in how we talk about or what we talk about on these presentations going forward. So the first question is, why is the Canadian dollar hitting multi-year highs, and what are the implications for investors? So the first thing, as most of you may know, the Canadian dollar has been extremely strong over the past year. Since we bottomed out in the markets in the COVID crisis in the early part of 2020, the Canadian dollar has been on an extremely strong rally. And this is going against not just the US dollar, but other currencies as well. This has generally historically been aligned with commodity bull markets. And so the chart I've got on here, the green arrows going up are showing those commodity bull markets on the far left from that 02 range all the way up to 2008. We hit the 2008 financial crisis, and we see this move away from smaller currencies such as the Canadian dollar back to the US dollar. But once we see that crisis end, resumption of the commodity bull lasts right up until about 2010. And for those of you who've been SIA chart subscribers and SIA Wealth followers going back that far, in 2010 is when we pulled the commodities out of our portfolios, and we saw commodities drop dramatically in that. From that point forward, we've seen a decline from 2011 down until 2016. We saw a decline in the Canadian dollar versus the US dollar, and then again in 2020 we saw another decline as the money chased more secure currencies such as the US dollar and moved from there. So a couple of reasons, other reasons why this is happening outside of the commodity side, and I'll get into that in the next chart, is stronger growth is being expected outside of the United States as well. So we're seeing money flows moving into Canada, moving into Europe, moving into other jurisdictions. The other part of it too is that the Federal Reserve is looking for a US dollar to help its exports. So inflation is driving the price of everything up, and inflation is one of the questions today. So having a weaker US dollar is certainly going to help the Federal Reserve compete globally and offset some of those costs to foreigners like ourselves, as they are a net export company or country. But commodities, it really, if you look at these charts, I pulled up 6 charts today. We've got copper, platinum, lumber, palladium, canola, and uranium are all commodities that are in absolute tears to the upside. Copper, bottoming under $2, or sorry, just above $2, has moved now up into that 470 range. So very, very strong growth, a great barometer for economic activity, copper. So this is showing us there. Platinum and palladium, a lot of base metals that are used in the electrification of automobiles and other areas of this greener society are seeing strong runs. Platinum and palladium are part of that. Uranium, bottom right corner, has had an extremely strong run as we see more governments now reducing the restrictions on potentially using reactors to generate electricity as the world moves to green. Lumber, absolutely explosive, top right corner here, moving up to the upside. I mean, we're down into that 250, 260 range. hit 1,700. Absolutely explosive growth there. And canola, I just highlighted middle bottom. Really we're seeing some of these softs do extremely well at this time as well. So this is helping the Canadian dollar. These commodity surges are there. But some of that inflation protection that the U.S. is looking for, and certainly capital is, and we've seen this move. If you think back to when we came out of this global crisis, there was a lot of money flows were headed to international in favor of their quickness to back to market post-COVID, but also some of the other growth areas that they've had. The next question we have is why is the NASDAQ falling more than other U.S. indices? And what is happening with sector rotation? The chart I've put up here is the NASDAQ composite versus the S&P 500 index, so a comparison chart. And what we're looking for in this, if the chart is moving upwards, this is an indication that the NASDAQ is dramatically outperforming the S&P 500. And we can see really back to 2006, the NASDAQ has been on a tear. So essentially long NASDAQ and short S&P 500. Your money was better served in the NASDAQ index than the S&P 500 for the last 15 years. What we've seen though, there's been only a few times since 2006. In 08, we saw the S&P 500 outperform the NASDAQ. We saw just briefly a little bit of time there in 2013 where we see a column of O's go below the previous column of O's, quite immaterial back in 2013. But we looked at 2021 and we see the relationship is showing some signs that there's potentially a fundamental shift on where these money flows will go, at least on an intermediate term basis. So that chart signal at the top, very strong. Even on comparison charts, you like to look at chart signals. What we see here is a triple top breakout followed by a high pull warning and then a triple bottom breakdown. Pretty material. So this gives me a little bit more confidence as a technician that this relationship is going to turn this way. But what we've seen so far is that this has really been a rotation away from those favorite sectors that we saw post-COVID or the bottoming of the markets in the COVID era until now. So if we look at February 1st, 2021, I just took a snapshot, and Paul spoke very clearly to this when he was talking about what's happening in our North American product, is that there has been a rotation. So in the favored sectors back in February 1st, 2021, we see electronics and semiconductors, computer hardware, and internet. These are, three major components of the NASDAQ composite. When you go to May 17th, none of them are there. Like they're all gone. So we see a different type of grouping in there. We see things like wholesale is in there. We see consumer non-durables coming in there, construction coming into the favored. And believe it or not, I had to check my eyes on this one, energy moving up into the top. And I know we've been on the energy story for some time in our portfolios, but to see it in the top of sectors, I'm going to have to go back and look back in time. It's been a long, long time since that sector has been in the favored. Retail has been in there. It's moved down a little bit, but chemical. So a totally different composition is now in the leadership, and this is favoring the S&P 500 and some of those more broader based, I guess, Main Street types of sectors are benefiting from that. So again, we're not seeing a major correction in that, and this question will help answer that as well. Our equity markets fully valued here. So here's the S&P 500, the NASDAQ that I just talked about. That chart's looking a little bit negative at this time, but the S&P 500 continues to look bullish. The chart shows us there's potential upside to the 4,500 range with support nearby around 4,000. So 4,500 is the next sort of test for this index. Near term, you could certainly argue that we're overbought on a lot of these indexes. I mean, there's a long pull up after a triple top breakout here back in the latter part of 2020. We've been on a tear upwards from there. So a pullback from here would be not something that we would see as unreasonable or unlikely. But at this moment in time, we would still consider this a very bullish chart. We're not even in a column of O's at this time. So we don't see markets too extended at this moment in time, and we'll watch for a short-term pullback. The S&P TSX, it also continues to look bullish. The chart shows us upside to the 22,000 range with support nearby around 18,000. Again, the TSX composite could be considered near-term overbought. We could see a pullback in the market, but a very, very productive chart. Both of these charts are still looking strong. We would expect there would have to be some material changes in the environment for this to get unseated, at least in the near term. Looking at the next question, could the recent spike in commodities boost inflation and force central banks to raise their interest rates? Well, let's take a look at that. So the charts that we have on the right here is the 5-year US inflation chart on the top. It shows a spike up recently. So the more recent numbers saw a dramatic increase over 4%, was seen well above expectations within the United States. So we are seeing that. I think that speaks clearly to some of that commodity story that we've seen earlier. The cost of production is certainly going up. Housing is going up, a lot more expensive to build. Vehicles, cars, used vehicles are going up. That's contributing a lot to this inflation spike. The next chart below is the 25-year US inflation rate chart. And so we can see in the context of what we're looking at there is over a 25-year time frame that we have seen levels up as high as we are. So I don't think that this is extreme cause for concern. And if you look at the longer term chart, if you go back to the history back to around 1940, this inflation spike that we're seeing here would measure as a very, very small blip. That being said, inflation fears are warranted. I mean, we don't see anything, a little bit of a pullback on lumber, a little bit of a pullback in other commodities, but nothing material to date reflecting any change in direction. So we'll watch that. But so we do see inflation is warranted. The area that we're watching to measure what's the response going to be, what's the market's going to demand as far as interest rates. We clearly know that the market is being fed by tremendous stimulus, and low interest rates is a big part of why we've had such a dramatic equity run in a post-COVID world. So clearly we're going to be watching these interest rates very, very closely. The top chart here is the 5-year interest rate. It's moved back into its 10-year trading range. So we saw it move down below, that 5% level, or sorry, 0.5% level. Tremendous drop during COVID as governments really slashed their rates. We've seen it creep up. We're watching that 1%. So that's an intermediate term. That's a near-term level that we're watching closely to see if those inflation numbers that we saw in the previous slides are going to get problematic for us. We'd see that raise. But again, until we move even through that top side, so that's more of that 2.5% range, we don't really see a dramatic change over what we've seen over the last 10 years or so. The 30-year, which is the chart below, a very, very similar chart. We see that it's spiked well below its longer term, that 10-year trading range where it's been stuck in for quite some time. So we've set that interest rate, we're watching that 2.5% level for a near-term breakout, which would give us some pause, and potentially we would be seeing stronger inflation at that time. So we're at this crossroads on both of these charts. Even if we breach those, we'll see what happens as far as the reaction from central banks around the world in doing that. They've clearly been speaking a lot about not as much fear about inflation. I think on our side of the table, though, we do have to watch it. Here's a couple areas that we're watching it, and we'll alert if anything changes. Our final question today, over the past 3 months, the iShares China Index ETF XCH has declined 20%. What has contributed to this weakness, and will it persist? So, right out of the gate, there's a major difference between China and some of the other economies. We see in the top chart here, this is some of the fiscal measures that are going in, the stimulus that's going into the system. The US is leading dramatically over it. We can see China well down and below most other countries, really just competing with the economies as relatively as small as the UK. So that lack of stimulus, as they pull back that stimulus, that's certainly adding to the correction that we're seeing in China. The other areas, there's this underlying political unrest, and it's being seen in the forefront really with the relationship with Australia. There's certainly some sword rattling going on between these two nations at this time with trade sanctions and certainly a lot of commentary coming out that is negative against each other. So we'll see if this continues. And Australia probably is a reasonable proxy for other Western nations as we see the giant China coming to itself in a post-COVID world. It's likely that we may see some allies either align with Australia or potentially throw it under the bus, but traditionally we would expect those interests to align a little bit more. So these are a couple areas where we're at, but let's take a look at the chart. So if we look at XCH, we can see that it has rotated down here from 32 and change now down to 25. That reduced stimulus and the political uncertainty certainly could have a role here. But I think there's a stronger place to play in this, and that's just as we saw with the NASDAQ, is that we're seeing a rotation away from those names that have been extremely strong coming out of the gate. So China does have a significantly large tech sector, which has come a little bit out of favor. So I think when we put in the reduced stimulus, the political uncertainty, that change in rotation of companies, that's going to explain a lot of what we've seen in the Chinese stocks. Specifically, we're commenting on XCH today and its decline in that. So, really just broke below its uptrend line. We've seen this happen a couple of times over the last 6-7 years with this stocks, with this ETF, sorry. So we'll watch it a little bit closer, but I think that's really what we're should be talking about, is largely just what we're seeing with NASDAQ. So, potentially some of these ESG funds that have been extremely popular, some of these pure tech plays, up and coming tech plays could be more at risk in the NASDAQ side. And that rotation, as we've seen in our North American product, away from that into those favored sectors that are in place right now, I think is a rotation there. And when I look through the charts, these do look material. Quite often we see these types of fundamental changes in sectors be short-term lived, and we've seen that a number of times since the bottoming in 2020. This time, it does appear that the chart signals are much more negative. The relative chart positions are much more negative. So that gives me more strength in my conviction as to making those changes and rotating into the economy, and our North American fund certainly has highlighted that. So that concludes the 5 questions for today. We'd love to have you guys send and gals send more questions in. Please send them to sales@siawm.com. That's sales@siawm.com. We take those questions, we consolidate them into 4 or 5 questions for each monthly seminar, and we really appreciate those questions coming in and your audience today. So with that, we're going to end the webinar, and we'll see you in a month. We obviously will have other insights that will come in, and by all means, if you have questions in the interim that you need answered for yourself, for your clients, reach out to myself or any member of the SIA Wealth team. So thank you all.